This is a sacred, tax-free cash cow. In this episode, I'm going to address the question, why is a max-funded IUL, Indexed Universal Life, tax-free? You're going to understand why this is so powerful, and it's been protected in the Internal Revenue Code for more than a century. So, my name's Doug Andrew. I'm here in my radio studio. I've been a financial strategist for more than 45 years, but I've been blessed to have a national broadcast radio show now for the last 11 years. And so this is my studio where every week I address questions that people have. If you're on this YouTube channel, you know perhaps that I answer a specific question every single day that has been asked 30 to 300 times a month for the last several months. So thank you for joining me. And in this particular episode, I'm going to answer a question that has been asked me thousands of times. Why is max-funded IUL, Indexed Universal Life, tax-free? I mean, is this a loophole? I mean, when the IRS, when Congress finds out about this, they're going to close up that loophole. No, they know very well what they're doing. It's been like a sacred cash cow for as long as the Internal Revenue Code has been around. So let me share with you 3 sections of the code as we currently have them that has sort of grandfathered, protected the money that grows inside of an insurance policy, so it's tax-free. And it also allows you to access the money tax-free. And when you ultimately pass away, it blossoms in value, increases in value, and transfers income tax-free. And it's because people are taking ownership of their own future, taking pressure off of the government to provide benefits or take care of them, or their widow or their orphans they may leave behind if they die sooner than later. And so, no, it's not some tax loophole. It's actually a sacred cow. And I'm going to explain to you the 3 sections of the code that have been providing this incredible opportunity now for more than 100 years. So, as a financial strategist, helping people plan for their retirement for 4.5 decades, I've noticed a lot of people are under the understanding that, well, I've been told to put money into the company's 401k. Or an IRA. And they did that sort of following the herd. Everybody does that, right? Thinking that they would be in a lower tax bracket when they retired. But lo and behold, when they retired, they weren't in a lower tax bracket. Why is that? It's because when people save for their future, oftentimes they're going down the highway, so to speak, trying to achieve their destination of financial independence with one foot on the gas pedal, but the other foot was on the brake pedal. And they didn't know they were doing that. So they're deferring their tax on those IRAs or 401ks until they retire because they thought they would be in a lower bracket, but they're not. And it's mainly because they sort of kill their tax deductions with the other foot on the brake pedal all throughout their lifetime. They pay off their house, so they no longer have that mortgage interest deduction. They're not contributing money to IRAs and 401ks after retirement, so you don't have that deduction. Your kids are gone, so you don't have that deduction, or if they're not gone, you can't deduct them anymore, okay? And Congress keeps raising taxes because of irresponsible government spending, the printing of money. And so most Americans, when I ask them, how many of you think that future taxes are going to be lower? Nothing but crickets. How many think they're going to be the same? Oh, a few people raise their hands. But when I ask, how many of you think taxes will likely be higher in the future? And the vast majority of people raise their hands. And then I go, so why are you postponing, deferring, paying tax, procrastinating, and accumulating your money tax deferred to some big amount, future perceived unknown advantage, and then withdraw your money down the road when you're convinced taxes will be higher in the future? That doesn't make sense. And they go, yeah, what's up? And so that's when I introduced to them the concept that it would be far better to pay tax on the contributions they're making, okay? Contribute money to an account with after-tax dollars. And people say, well, like a Roth? Well, yeah, a Roth's okay, but it has too many strings attached because they limit you on how much money you can put into a Roth. How fast, how much, when you can tap into it. You have to wait 5 years until you're 59 and a half. I don't like all those strings attached. So I can have all the benefits of a Roth and 4 additional benefits with a max-funded IUL because in the Internal Revenue Code, it's the only vehicle that for over a century allows you to accumulate your money with interest totally tax-free under Section 72E of the Internal Revenue Code for over 100 years. Under Section 7702, it's the only vehicle that then allows you to access that money tax-free the smart way, and I've been able to earn average rates of return between 8 and 10% tax-free. So every million that I accumulate by the time I retire can generate $80,000 to $100,000 a year of tax-free income, and that income is tax-free under Section 7702. Now, ultimately, when I pass away, because none of us are getting out of here alive, I don't mean out of this room, out of this life, okay? So when we ultimately die, the reason why I like max-funded IUL is because it blossoms in value and transfers tax-free. When I say blossom, that means increase. If I died right now at my current age of 68, every million that I would have in a laser fund would blossom to about 2.5 million instantly and transfer income tax-free to my wife, to my kids, to a church, a charity, the Boy Scouts, the Red Cross, or whoever I leave it behind to. So there's nothing else in the Internal Revenue Code that does that. So that's Sections 72E, 7702, and 101A of the Internal Revenue Code. I've been teaching these sections of the code to CPAs and tax attorneys, financial advisors, in advanced continuing education for decades. You wouldn't believe how many times they come and they sit down and they go, well, I've heard of those, but I guess I never really understood them. I wasn't required to understand these when I got my LLM degree. What's that? That's a master's in taxation. They weren't required to learn about these. That's why it's advanced continuing education. They're learning about this after they became a CPA, after they got their master's in taxation. Why? My heavens, this is one of the most incredible tools that I have ever used to help people retire. So when people ask, why is max-funded IUL tax-free? It's very simple. It's sort of been grandfathered that way, protected as a sacred cow in the Internal Revenue Code for more than 100 years, because every time Congress has wanted to maybe reassess, should we start taxing these? It's not a tax loophole. They know what they're doing. But if they get hard up for money, the tax revenuers sometimes say, let's go pluck that sacred plum over there, those tax-free insurance policies. Well, every time they've studied that, they realize that's not going to come out ahead for them, because if they take it away by taxing it, they might get a short-term little windfall of tax revenue, but in the long run, the government will shell out far more money to the people they took it away from. Why would you penalize and take away from a widow or orphans when you left behind insurance proceeds, for example, to make sure that they didn't become a drain on society, that they were self-reliant? Why would you penalize people for trying to be self-reliant or financially independent? And so life insurance has been a sacred cow for years, whether it's for death benefit that's tax-free or for living benefits. Because if I can sock away money and every million generates $80,000 to $100,000 a year of tax-free income, and that's far better than relying on Social Security or the government to take care of me, I'm actually benefiting America. I'm helping America. And so it's not like this, oh, you are using a tax loophole. You're not paying your fair share. Actually, I'm doing more for America by being self-reliant, financially independent, and not draining the resources that government tries to provide for people who would not save. That's what Social Security was really all about, to provide income from people who did not save or refused to save. They were always spending throughout their lifetime. This is one of the reasons why I love max-funded IUL. It's sort of this sacred cow. Every time they've even been tempted to change the tax laws, they've said, leave it alone. It will cost us more than it makes us. So let me give you the takeaways from this episode. So max-funded IUL, Indexed Universal Life, is an instrument that if you use it for a living, tax-free, income-producing vehicle, then I can prove in other episodes, subscribers to this channel watch several different episodes to understand how this will knock the socks off of a traditional IRA or 401k. You'll have more income by as much as 50 to 100% more, 80,000 of income instead of the industry standard of 40,000 on every $1 million. It's totally tax-free. If I live to be 120, it does not deplete principal, and it's afforded under those 3 sections of the Internal Revenue Code that I taught you. Section 72E, accumulate your money tax-free. Section 7702, access your money totally tax-free the smart way. And when you ultimately die, it blossoms in value and transfers to those who you leave it to totally tax-free. Nothing else does that. If you comply with 3 tax citations, TEFRA, DEFRA, and TAMRA, these are tax citations. If you do that correctly and you fund it properly, it will be a superior vehicle, and it's not some dream or tax loophole. And so if you're curious, you can search on this channel for answers to questions about TEFRA, DEFRA, and TAMRA. But I'll tell you what, I have my most recent best-selling book. It's The Laser Fund. It's actually 2 books in one. This side is 200 pages, 14 chapters, all kinds of charts and graphs explaining why this works. The Laser Fund is what I call a max-funded IUL. This side is 12 chapters that contains 62 actual client stories and examples. If you want to use your right brain and your left brain, I would recommend you read both of these books. 300 pages. Now, I'll buy the book. I want to gift this to you free. You just go to laserfund.com, pay $5.95 shipping and handling, and I'll fire one out to you, and you'll have options to even get the audio version or the digital version and 10 master classes if you want. But this is the beginning step to empowering yourself to accumulate, access, and transfer your money totally income tax free.